Investing during times of war, navigating the chaos, seizing the opportunities. As history unfolds before us, and certain conflicts become hotspots, financial markets are engulfed in a cloud of ambiguity. But in this video, we delve deep into the art of investing amidst the chaos. We'll explore the intricate dance between war and investments, shedding light on the immediate impacts of wars on markets and distilling lessons from the lockers of history. Join us as we embark on a journey through time and financial wisdom, striving to understand how investors can safeguard their interests in the most testing of times. This is not just a conversation about war. It's a dialogue about the financial resilience and wisdom needed to weather the storm. If you're ready to explore the intricate world of investing during times of war, hit that subscribe button and stay tuned for a comprehensive discussion that could transform the way you approach your investments. Welcome to a world where knowledge is your armor and strategy is your sword. The ever-evolving landscape of global geopolitics. Investors often find themselves grappling with unprecedented challenges, and few challenges are as pressing and emotionally challenging as the complexities surrounding times of war. In this video, we will discuss how investors can best maneuver the fine line between war and investment. We'll help you understand the immediate impact of wars on stock markets worldwide by looking at historical precedents, and how you can apply the lessons learned from these past events to the current geopolitical landscape. Alright, as always, I have prepared a little presentation. How do you best invest during times of war? Here's the table of contents for today's discussion. First, we must remember that short-term reactions to crisis events often lead to poor results. Emotions like fear and greed can drive investors to overemphasize short-term developments and underestimate the resilience of businesses in the long run. Here's a caution against short-term moves like trading commodities or using put options. Short-term reactions may not align with a successful long-term investing strategy. Avoid trying to be a military forecaster. Stay focused on what you're good at, investing. Uncertainty can create opportunities, and you must remember this mindset during uncertain times. Now let's draw an inspiration from Warren Buffett's experiences. During the 2018 Berkshire Hathaway shareholder meeting, he shared how he bought his first stocks during World War. Buffett emphasized the importance of a long-term outlook. He highlighted that investing in America over time could lead to significant returns. Now let's look at some historical data. How did stock markets behave during times of war? We'll examine the average drawdowns and recovery times. Historical market performance during past geopolitical events suggests that markets are generally resilient in the long term. Short-term concerns may not significantly impact long-term investors. Maintaining a long-term outlook is key. Stock markets are the asset class to be invested in. If you can maintain that perspective, remember to track the impact of geopolitical tensions on the businesses in your portfolio. Stay focused on the long term and stay vigilant. Uncertainty can indeed create opportunities. The impact of war on your investments will depend on several factors, including the duration and intensity of the conflict, your specific investments, and your investment strategy. Investing during times of war can be challenging, but some areas tend to show resilience or even opportunities. Here are some investment areas to consider during such times. Market volatility. Geopolitical events, especially those involving war or conflict, can introduce volatility into financial markets. Investors may become more risk-averse, leading to increased market fluctuations. Sector-specific impact. Certain sectors may be more affected by the conflict. For example, defense and aerospace companies may see increased demand for their products, potentially benefiting their stock prices. Conversely, companies with significant exposure to the affected region or those dependent on oil imports from the region may face challenges. Oil prices. The Middle East is a major oil-producing region, and any disruptions in the region can impact global oil prices. An increase in oil prices can affect various industries, including transportation, manufacturing, and consumer spending. Global economic impact. If the conflict escalates and disrupts trade routes or global stability, it could have a broader impact on the global economy, potentially affecting various asset classes. Diversification. A well-diversified investment portfolio can help mitigate risks associated with geopolitical events. By spreading your investments across different asset classes and geographic regions, you can reduce the impact of a single event on your overall portfolio. Long-term perspective. It's essential to keep a long-term perspective when investing. While short-term market reactions to geopolitical events can be unpredictable, historical data has shown that markets tend to recover over time. Avoid making impulsive decisions based on short-term market fluctuations. Risk tolerance. Your risk tolerance and investment objectives will play a significant role in how you respond to market events. If you have a low risk tolerance, you may want to review your portfolio and ensure it aligns with your comfort level. Monitoring and adaptation. It's essential to stay informed about the situation and adapt your investment strategy as needed. This may involve rebalancing your portfolio or making changes based on changing circumstances. Gold and precious metals. Historically, gold has been considered a safe haven asset. Its value tends to rise during geopolitical turmoil, making it a hedge against currency devaluation and uncertainty. Utility stocks. Utilities, such as water and electricity providers, are considered defensive stocks as they offer essential services that people rely on, regardless of the geopolitical situation. Healthcare. Pharmaceutical companies and healthcare providers are typically recession-resistant. They tend to perform relatively well during challenging times due to consistent demand for medical services and products. Infrastructure and reconstruction. In the aftermath of conflicts, there's often a need for reconstruction. Companies involved in infrastructure development and construction may benefit from government-funded projects to rebuild and stabilize war-torn regions. Foreign exchange markets. Currencies can be highly affected by geopolitical events. Traders often seek to capitalize on fluctuations in currency exchange rates during times of war. Dividend-paying stocks. Companies with a history of paying dividends may provide a source of income and stability during turbulent times, even if the stock price experiences fluctuations. Technology. Some technology sectors, particularly those related to communication and cybersecurity, may see increased demand as governments and organizations focus on secure communication and data protection. Bonds and fixed income investments. Government and corporate bonds can be considered safe haven assets during times of war. They provide regular interest payments and return of principal upon maturity. Real estate investment. Real estate, particularly rental properties, can provide a steady source of income and may retain value, especially in stable, economically diverse regions. Humanitarian and ESG investments. Some investors choose to invest in companies that focus on humanitarian efforts and environmental, social, and governance (ESG) principles, aligning their investments with their values. As we conclude this insightful journey into the art of investing during times of war, we hope you've gained valuable insights and strategies to secure your financial future amidst global uncertainties. If you found this video valuable, please show your support by hitting the like button and sharing it with friends and fellow investors who might benefit from these insights.